$32 billion of trust vanished in a week, and roughly $8 billion of customer money was missing. Behind the ads, FTX had a hidden door into its founder's trading firm, Alameda. One leak sparked a run. The token crashed, withdrawals froze, and the empire broke. A jury convicted Sam Bankman-Fried on all 7 counts. He got 25 years. Rewind. The story starts with a math whiz. Sam Bankman-Fried studied physics at MIT, then made money as a quantitative trader on Wall Street before jumping into crypto. In 2017, he founded a crypto trading firm, Alameda Research. 2 years later, in 2019, he launched a crypto exchange for everyone else to use, called FTX. His public image was carefully frugal. He drove a beat-up Toyota Corolla, wore cargo shorts and a rumpled t-shirt, and slept, he said, on a beanbag at the office. FTX also created its own cryptocurrency, a token called FTT. This matters more than it sounds. The company had invented an asset it could print more of whenever it liked. He talked constantly about giving his fortune away, effective altruism, earning billions in order to donate them. It made him look less like a gambler and more like a saint. Investors, politicians, and reporters mostly loved the story. Almost nobody asked the boring question, where exactly was all of the customer money being kept? The timing was perfect. Crypto was booming, and FTX grew at a genuinely staggering speed, signing up users around the world in just a couple of years. By early 2022, investors valued FTX at around $32 billion. Some of the biggest names in venture capital handed it money and barely looked under the hood. Then came the marketing blitz, a Super Bowl commercial, glossy magazine covers, and A-list celebrities telling ordinary people that FTX was the safe, easy way into crypto. FTX bought the naming rights to a Miami sports arena and plastered its logo everywhere. The message was simple: we are huge, we are trusted, and you are missing out. It worked beautifully. A brand new company most people couldn't explain suddenly felt as solid and permanent as a bank. Fear of missing out did the rest. FTX's own token, FTT, rode the wave up to around $80. On paper, everyone was winning. On paper, unfortunately, is where this kind of story keeps happening. Here is the setup that made the fraud possible. There were 2 companies, FTX, the exchange where customers kept their money, and Alameda, the founder's private trading firm. They were supposed to be separate, with a firm wall between them. But the same man effectively controlled both, which is a conflict of interest roughly the size of a building. This distinction is everything. When you deposit money on an exchange, it is supposed to just sit there safely as yours, the way cash is supposed to sit in a bank vault. Alameda, meanwhile, was a hedge fund. Its whole job was to make big, risky bets with money, hoping to win. And, like any gambler, sometimes losing very badly indeed. And a huge chunk of Alameda's supposed wealth was not cash at all. It was FTT, the very token FTX had invented and could create more of at will. So one side held other people's money. The other side gambled and sometimes lost. All that stood between them was a wall. And that wall, it turned out, had a door. Regulators and prosecutors later described what happened. Billions of dollars in customer deposits did not stay safely on FTX. They were quietly routed across to Alameda. Alameda then spent that customer money as if it were its own. Risky trades, huge loans to executives, political donations, venture investments, and luxury real estate in the Bahamas. Some of those bets lost, and lost badly. But the losses stayed hidden, because on the books, Alameda still looked rich, propped up by that self-issued FTT token. It was a closed loop. FTX printed FTT, Alameda counted FTT as a valuable asset, and FTX quietly lent Alameda real customer cash against a token FTX controlled itself. As long as FTT held its price, the tower stood and everything looked solvent. The entire structure balanced on the value of a coin the company controlled itself. It had exactly one requirement to keep working. Nobody could look too closely at Alameda's balance sheet. In November 2022, somebody finally did. The problem with building your fortune on your own token is that the number is only real if you never have to sell. Alameda could not quietly sell billions of FTT. On November 2, 2022, the crypto news site CoinDesk published a leaked look at Alameda's balance sheet. Much of its assets, it reported, were tied up in FTT. Specifically, around $5.8 billion of roughly $14.6 billion in Alameda's assets were linked to FTX's own token. People started doing the math. If Alameda's wealth was mostly a coin FTX printed, then how solid was FTX itself? For the first time, the word people whispered about the empire was insolvent. Publicly, Bankman-Fried stayed calm and reassuring. FTX is fine, he posted. Assets are fine, a message he would very quickly delete. But confidence in crypto can evaporate in hours, not months. And a very powerful rival had just read the same balance sheet everyone else was now staring at. On November 6th, the head of Binance, FTX's biggest rival, announced his company would sell its entire holding of FTT. It was a lit match next to a puddle of fuel. The price of FTT began to fall and then to collapse. As it did, the value of Alameda's assets fell with it, and the whole closed loop started to unravel at once. Customers did the only rational thing. They rushed to pull their money out. An estimated $6 billion in withdrawals hit FTX in about 72 hours, and that is when the trap sprang shut. On November 8th, FTX halted withdrawals. The money simply was not there. It had been across the wall at Alameda all along. Binance briefly signed a letter of intent to rescue FTX, then opened the books, saw the size of the hole, and walked away within a day. No one else stepped in. On November 11th, 2022, FTX and around 130 related companies filed for bankruptcy. A $32 billion empire had gone to zero in roughly a week. When the new managers finally counted, the gap between what FTX owed its customers and what it actually had was enormous, a hole of roughly $8 billion. Behind that number were real people, more than 1 million creditors, ordinary savers, traders, and small businesses who had trusted a friendly app with their money. Overnight, their accounts were simply frozen. Balances they could see on a screen were suddenly impossible to touch, with no bank guarantee and no obvious way to get them back. The shock rippled outward. Other crypto firms exposed to FTX wobbled and, in some cases, fell, a chain reaction that deepened an already brutal crypto winter. Employees lost their jobs, and the polished, trustworthy brand, the stadium, the celebrities, the Super Bowl ad, curdled into a global symbol of everything crypto could get wrong. The obvious question was now unavoidable. Was this a horrible accident and a run of terrible luck? Or was it, from fairly early on, a deliberate fraud? The law had an answer. In December 2022, Bankman-Fried was arrested in the Bahamas and extradited to the United States to face criminal charges. The good guy image cracked. His closest colleagues turned on him. Alameda's chief executive, Caroline Ellison, and FTX co-founders Gary Wang and Nishad Singh all pleaded guilty and agreed to testify against him. Prosecutors charged him with a stack of crimes: wire fraud, multiple conspiracies, securities fraud, commodities fraud, and money laundering. 7 counts in total went to a jury. At the trial in the autumn of 2023, his former friends described in detail moving customer money to Alameda and building the balance sheet on the FTT token. On November 2nd, 2023, 1 year, almost to the day after the collapse, the jury convicted Sam Bankman-Fried on all 7 counts. Every single one. In March 2024, a judge sentenced him to 25 years in prison and ordered him to forfeit around $11 billion. The Corolla and beanbag era was over. Then came a genuinely strange twist. Under new management, the FTX estate recovered so much through asset sales, clawbacks, an Anthropic stake, and a crypto rebound that it planned to repay most customers in full. But do not mistake that for a happy ending. Customers were repaid the value of their accounts back in 2022, not today's prices, and a jury still found the whole thing was fraud. The lesson survives the payout. An exchange is not a bank, a brand is not proof, and your funds are safe is a claim to verify. That was FTX, a $32 billion promise of trust, quietly gambled through a door that was never supposed to exist. For more true stories of fortunes made and lost, stick around.